So what is the mechanism? The mechanism, at least domestically, applies to Europe, the United States, is that we have what I call a double downward spiral. The balance sheets of households and financial institutions were being essentially destroyed or badly damaged by virtue of falling asset prices. And falling asset prices were caused by the deleverage process, the process of trying to get debt out of the system. When those balance sheets were damaged and credit dried up, and in addition, households had less wealth, so they reduced their consumption. And now you go over to the real side of the economy. Consumption goes down, investment goes down, unemployment goes up, jobs are lost, and profits go down, and creditworthiness goes down, and then that goes back and does further damage to the balance sheet. So you can see that in a normal recession, most of the action is on the real economy side. In this case, we have a sort of a balance sheet recession in which both the real economy and the balance sheets of households and financial institutions and other entities are declining, and we have not yet stopped this process. Now, some of it was inevitable and had to happen because the balance sheets were so badly damaged. Capital started to flow back into the financial institutions in America and Europe on an emergency basis to try to shore this up. And what this produced is both a dramatic reduction in capital inflows to developing countries and actual capital outflows that had nothing to do with, or very little to do with, the actual economic conditions in developing countries, but were rather sort of flight to emerge measures in the advanced countries. This produced two things immediately and very rapidly in the fall and continuing today. One was a very quick and severe tightening of credit in virtually every country in the world because of this sort of emergency capital removal. And the second thing was a rapid decline in exchange rates. You can see this if you, and I may send you some pictures, but if you look at the major developing countries' exchange rates, in every single case, with the exception of China, the exchange rate depreciated, which is just it's not necessarily a bad thing. It depends on the circumstances, but it's a reflection of the capital suddenly flowing out. So the developing countries, if you look at the developing countries from a point of view of kind of where they were in the last 2 years, you start out with a situation in which there was very rapid global demand and a very rapid rise in commodity prices, including foods, basic foods, grains, rice, wheat, etc., oils, and oil and gas. It wasn't confined to those, but those are the most important. So developing countries face the problem basically of two things. One, an emergency situation with respect to the poor, and secondly, an inflation problem because food and energy represent a significant fraction of household budgets, the consumer price index, and the GDP of most developing countries. The more so, the poorer they are. That looked like a big challenge, but sort of manageable because it wasn't clear yet that we were going to have a global recession. What happened in the fall of 2008 is that global demand declined so sharply that commodity prices actually came down and alleviated the original problem. But then two things struck the developing countries, again with slightly different effects depending on the country. One was such a dramatic reduction in global demand that exports have fallen precipitously. They're in free fall now. Exports globally are probably 25%, and in many countries, those in their data. And second, you had this credit tightening. So the transmission mechanism that's operating now really has two principal components. One is the tightening of credit because of the damage in the advanced countries in the financial sector. And the second one is what we hope to avoid, which was a substitution of global demand for exports and the economy side. This is a very serious, we are in the midst of downward spiral of global economy on both the asset side and the real economy side, and we have not yet found fault. People have different opinions of this, but my opinion is that if we had moved massively in a coordinated way globally 3 months ago, we probably would have had a less deep and less lengthy economic slowdown than we are likely to have. How serious is it? I think we, at the minimum, are in for 2 years of very substantially diminished economic opportunity in the global economy. The IMF projections have been revised downward 5 times in a row, and their current projection for global growth is as close to zero as you can get. All major developed economies are going to have negative growth, which means their GDP is going to decline, probably for at least next year and maybe even 2010, meaning 2009, the year we're in, and 2010. But the important point is that the financial markets have not stabilized yet. There is no private capital to speak of flowing in substantial amounts into the financial sector, and the job losses are enormous. The United States lost, I believe, 600,000 jobs in January of 2009 alone, and probably 2.6 plus million in the previous year. I won't try to summarize Europe, but in many ways, Europe has even more serious problems. So that's the situation we're in. I think it's fair to say that the developing countries are sort of innocent bystanders in this, and we were hoping that the financial crisis would not have too dramatic effects and the global slowdown wouldn't be too big. That might have been a possibility 3 or 4 months ago, but it certainly isn't now. So the developing countries are facing declining asset prices in many cases, credit tightening, declining exchange rates, meaning depreciation of the currency, which is in some ways a good thing, but it's not a good thing if you have dollar or euro denominated assets. And I would love to be able to tell you that we've turned the corner, and maybe in the next 3 or 4 months we will have turned the corner, however deep the trough may be, but I don't think it's fair to say we're there yet.